Today happens to be my nephew's 18th birthday. I gave him a book to read a few months ago to help him prepare for life after 18. I talked to him over the holidays and he still hasn't read it. So I decided I'm going to put together a video for him and I'm going to give him some advice on how to move forward as a young adult. Hopefully you'll be able to take advantage of this as well. What we're going to be talking about today is building your credit. There's a credit hack that I will reveal that can help anyone jump up their score in a short period of time. And then we'll talk a little bit about savings and investments.
Oregon Cash Flow Pro. More wealth, less debt, fast. And here's your cash flow consultant, James Barber. He's here to help you take control of your finances.
Let's get to it. Building your credit 101. Get some credit. Now that can be a credit card or it can be a personal loan. Either of those two things should be fairly easy to do when you're just starting out building your credit. The important thing is you get the credit. So credit card or a personal loan. You want to try to get a number of different types of credit. The sooner you can show that you can manage your credit responsibly, the higher your score gets. We want you to apply for an unsecured credit card at your local credit union or bank. And the reason you want it unsecured is because it doesn't tie up any money that you might have. You may not even have any money, but that's okay. Unsecured credit card. If you have bad credit and you're trying to rebuild your credit, you might have to get a secured credit card where you'll put money into a savings account that will have to stay in there as long as they're granting you access to credit. Same thing with the personal loan. You can get a personal loan that's unsecured or secured. Doesn't matter what the balance is at this point. We just need to establish your line of credit. We need to make small charges on it each month and pay those off each month so that you can establish a track record of on-time payments. If you want to have the highest score possible, don't ever make a late payment. Now I would say try to apply for more than one card, but not all at once. You might apply for credit cards once a month for 5 or 6 months in a row. And these can be store cards, gas station cards, bank cards. Basically, the more credit that you can get and the more credit that you can show that you can manage responsibly, but the higher your credit score is going to be, and the easier it will be later in life to get more credit as you need it. If you want to buy a home, if you want to get a car, and you also will qualify for the best rates. Starting out as young as possible will make it easier on you later in life. So we're planning for the future. Now, what I want you to do is once you get these credit cards, don't max them out, whatever you do. Don't look at them as free money. This is not free money. Credit cards can be very expensive. You have to use them responsibly. The best way to use them is to charge them during the month and pay them off each month. So what we want to do when you're first starting out is put small payments on them each month, pay it off, okay? That's going to help you establish a track record. Do it with as many cards as you get. Just do a small payment. It doesn't matter how much. It could be $10, $20, and then pay it off when your payment is due. As long as you pay it off when your payment is due, you're not going to pay any interest. Now, the other thing, too, is if you can get a rewards credit card, that's ideal. Rewards are great. You're going to do your normal spending, and you will get extra bonus points toward whatever. It's kind of like a little savings account. You can end up getting plane tickets. You can get restaurant gift certificates. You can even get cash back right into your account. The key with your credit cards is to stay below 30%. So if you have a $100 limit on your credit card, don't charge more than $30, or don't let that balance sit on there. You want your running balance to stay below 30%. If you're going to have debt on there that you can't pay off in 1 month, try not to go over 30%. This will keep your credit score as high as possible. Now, when it comes to the personal loan, the ideal way to start out is get an unsecured personal loan. They give you that money, put it in the bank. You can put it in a savings account. You can have it sit in your checking account if you want to. But the reason we're going to do this, we're not going to spend the money. We don't even need the money. We're just building our credit. The reason we want to get this money is to establish the credit. So we're going to set it aside and we're just going to pay it back with that money. It's going to cost a little bit of money in interest, not very much, but that's going to pay off later in life when your interest charges are a lot lower because you've got great credit. Personal loans. Set the money aside and pay it off over about 6 months. Now, the personal loans that you're going to qualify might be 1, 2, 3, 5-year loans, probably in the 2-year loan range if you don't have any credit. You still want to shoot for paying it off over 6 months. It's going to establish a track record. If you pay it off over 1 month, doesn't do anybody any good. They may not even report it to the credit bureau. So the keys to this are credit cards below 30%, personal loan, set it aside, pay it off over 6 months. You can pay off 1/6 each month, add in a little bit of interest charges, and you're good to go. You'll cover it. This is a great way to build up your credit. As many accounts as they will allow you to open. Now, once you build up your credit, you can close some of those accounts down, but for the most part, you're best keeping accounts open and not using them. That shows that you are a responsible spender. Now for the credit hack. If you have parents who have good credit and they have a credit card that they've had for a long time and they've never made any late payments on it, ask them if they will let you become an additional signer on the card. Become an additional signer on your parents' credit card. What does that do? That gives your credit the history of all of those good payments that your parents have made on that credit card. It's a great way to jump years ahead in building your credit profile by establishing this long history of good payments. You don't have to make the payments. Your parents are making the payments. They don't even have to give you a card to use. Just have them add you as a signer and you will get to take advantage of their good payment history. There's your credit hack, folks. Next step in the process, let's talk about savings. Your personal savings are very important in order to help you provide financial stability throughout your life. You typically want to have 3 to 6 months of income available to you on short notice. This will help provide you with the financial stability you need to overcome any type of emergencies that pop up. One of the things to consider is, where do you keep that 3 to 6 months? Right now in today's interest environment, savings accounts and checking accounts really are not a good place to store 3 to 6 months of income. You don't want thousands of dollars sitting in a checking or savings account that's earning nothing and not doing anything for you except for be your emergency savings. There are other things that we can do to save our money and have it be available, but also take advantage of growth that at least offsets inflation rates. Now, there happens to be my favorite vehicle of choice, which will offset your inflation rates, but also provide you a whole host of other benefits. This is what the book I sent him talked about, which is life insurance. Let's talk about insurance. Not just life insurance, we'll get to that, but insurance overall. Insurance in your life helps you from avoiding financial ruin. You're required to have car insurance. You're practically required to have health insurance. You need to have homeowners insurance if you have a home. If you're a renter, you get renter's insurance. If you're a landlord, you have landlord's insurance. The reason we have insurance is to avoid financial catastrophe. If you get in a car accident and it is deemed your fault and you don't have any insurance, you could lose everything, okay? They will come after every single thing that you own. If you end up with an injury or an illness, or you get sick for long periods, you end up in the hospital, you are going to pay a huge bill. Insurance is very important. Health insurance, when it comes to protecting your health and saving your money. So we've got auto insurance, car insurance, homeowners and renters insurance. If your house burns down or the place that you're renting burns down, you need to make sure that those costs are covered. You do not want to be without a home. It's not very expensive. It's well worth the cost. As a young person, I realize it's hard to understand how insurance can benefit you because currently you're young and you're invincible. I know, I was there. Trust me, it's worth it. The older you get, the more you realize how important it is. Typically, when you're younger also, you don't have as much cash available. You don't have as much money available. And so you end up having to have low deductibles so that if something does come up, you can afford the cost. Now, normally when we talk about life insurance, people generally think, I don't need life insurance until I have kids. But let's talk about the benefits of life insurance for even young adults. Life insurance has a whole host of benefits. But the big one, and the one everybody thinks about, is the death benefit. And this is usually the one where kids don't even think about this. Young adults don't even think about this. What do I need a death benefit for? I don't have any kids to pass money on to. I'm used to my parents taking care of everything for me, so I don't even consider that they might have a need if there were a tragic accident and if you were to pass away at a young age. But consider this, your parents have been taking care of you for 18 years or more. They have a lot of emotional and financial investment in your future. They want to see you succeed. If you were to pass away due to an illness, a tragic accident, who knows what, they're going to be devastated. They need time to grieve. What better way to give them time to grieve than with a tax-free death benefit? You don't want them having to go back to work because they have to continue bringing in money in order to support your siblings or the rest of the family, or maybe they're not very financially well off. Whatever the case may be, there's definitely a use for a death benefit. And as a young person, you can qualify for quite a bit of life insurance for a very small amount of money. So I want you to think about your parents and any other loved ones when we think about the death benefit for life insurance. There's definitely a need. Now, maybe you think my parents are okay. I just don't have the income now to think about that, or I want to establish myself more before I step into that. Whatever the case may be, whatever the excuse right now that you might dismiss life insurance, let's look at how you can take advantage of life insurance while you're alive. There's a couple of different kinds of life insurance. One is term insurance and one is permanent insurance. Term insurance is just there for a short period of time, whatever the term is, and then it goes away. It's very cheap, but it doesn't last past whatever the term is that you're paying for, okay? Permanent insurance, in the case of universal life insurance or whole life, it's there for your whole life as long as the policy is funded, and it builds cash value. This is where the benefits kick in. Cash value in life insurance is a very safe place to have your savings. Life insurance, depending on which company you're going through, you typically have that cash value available to you within 3 to 10 days. The life insurance companies are allowed up to 6 months to pay out on a loan or to give you a loan. But in practice, 3 to 10 days you can get your funds. So we look at it as a savings asset. Now this cash value in your life insurance policy, if it's a whole life policy, it's guaranteed to grow at 4% every year. And you may get higher growth than that. In an indexed universal life policy, you're indexed to the stock market, typically the S&P 500, and so you have the opportunity for even higher growth than that. But in either case, you're guaranteed that you will not lose money. That money that you put in there, yeah, you've got to pay the small cost of life insurance, but the cash value in your account will not lose money due to market losses. And in fact, with some policies, it's guaranteed that it will grow by a certain amount. Some life insurance policies can be utilized as a retirement vehicle, meaning you can set money into it each month, each year, and it's going to build, and you can take advantage of that when you go into retirement and pull out that money tax-free. The cash value in your life insurance policy grows tax-deferred, and you can access it at any point through policy loans tax-free. So it's a great way to utilize this tax advantage asset. Living benefits, so if you end up with a terminal illness, a critical illness, a critical injury, or terminal injury, you can access the death benefit before you die. That is a great way to avoid bankruptcy. It's a great way to make sure that you're going to get the care that you need prior to your death. Jumping back to retirement vehicle. The reason I like this as a retirement vehicle is because typically when we think about retirement, we think 401ks, IRAs, 403bs. These are other tax advantaged accounts that people use for retirement. The problem with those is it locks up your money. If you're 18 years old and you're putting money into a 401k or an IRA, you're locking that money up for 40 plus years. You can't access that money without penalties, sometimes without changing jobs. If you're not planning on quitting the job that you're at, but you need access to those funds, you may not have it. Some administrators or custodians will not give you any money from your retirement account as long as you're employed with the same employer. You have to change employers in order to be able to pull out that money, and then you still have to pay a penalty on top of that. So retirement accounts are not a good thing to start right when you're 18 years old if you have not built up your savings, and if you haven't made sure that you have enough funds for other things that you want to do throughout your life. So buying a car, buying a home, investing in other things outside of your retirement vehicle. This is where the life insurance policy really shines, and why I like it as the retirement vehicle in and of itself. You have access to that funds. There is no early withdrawal penalty. You can borrow against the funds tax-free. If you're thinking about this as a retirement vehicle, you pay back what you borrow, and all the funds stay in your account. So when you borrow money out of your life insurance account, you're actually borrowing against that policy. You're not taking the money out. So your funds that are in the policy will continue to grow. Depending on what type of policy you have, they might grow at the same rate as the money that you're borrowing, or you could get arbitrage where you're borrowing at this rate, but your account's growing at a higher rate. So there's different types of accounts available, and a lot of it depends on what your risk tolerance is as far as getting some guaranteed growth or having the opportunity for higher growth. But the guarantee is only that you're not going to lose any money. Now, some of this is going to go way over your head. If you have questions about any of this, be sure to ask them in the comments below. I'm happy to address them. A life insurance policy that's structured correctly has very flexible premiums. What do I mean by extremely flexible premiums? We might have, if we have this set up as an account that you want to put a lot of money into, say $500 a month, we can set it up to where the maximum amount that you're planning to put into this policy might be $500 or $600 a month, but the minimum might be $80, $90, $100 a month. So you've got a wide range that you can deposit that at any given time so that it fits your financial situation. Now, if you're funding a policy like a retirement vehicle, if you're putting a few $100s a month into it, and the minimum amount is $80, $90, or $100, you're going to be able to completely skip payments or stop making payments at some point without any worry that the account is going to implode. Now, with these accounts, any growth that we get in these accounts is locked in. In Index Universal Life accounts, there's what's called an annual reset provision, which means when that account goes up based on the index in the stock market, once it goes up, it will not go down. Whatever it goes up to is your new base. All of these accounts have guarantees that you will not lose money in the stock market. When it comes to whole life policies, you have a guaranteed 4% that it's going to grow every year. So whatever that amount is last year, you know it's going to be higher than the year before. This oftentimes looks like a step. Account goes up in value, goes up, up, up. These flat areas, in the case of an Index Universal Life policy, this might indicate where the market lost money. And then when it gains money, you gain money. And then it loses money again, loses money again, you stay flat, and then it gains again. And then it stays flat, or it loses money, and then it goes up again, and you go up again. So even though the stock market goes up and down, you only go up. It's a great opportunity for people who, one, don't have a lot of savings, are averse to risk. If you don't like to lose money, I don't like to lose money. It's a really great opportunity to build a nice, solid financial base. Now, once your solid financial base is built, then we can look at other investments. But you want to make sure that you have a safe foundation for which to build wealth on for the rest of your life. Now, with the life insurance policy, there's no age or income requirements. It provides you protection from lawsuits. The money that sits in your life insurance account is protected from lawsuits in most cases. It's also not counted when you go to apply for financial aid for your college tuition. So any money you've saved up as cash value is not counted. And finally, we can use this cash as it grows and grows. We can use the cash that's available in our life insurance policy for other investment opportunities. If I need money to buy a house, I need down payment, I can borrow that against my life insurance policy. If I need money to buy a car, I can borrow that against my life insurance policy. If I have the opportunity to buy a rental property, I don't even have to go to a bank to get approval. I can just borrow against my life insurance policy. I don't need anybody to approve that. That money is there when I need it. So we look at this as a savings asset. Okay? This is your money that's in the account. It's buying you a death benefit. It acts as a savings asset. You can use it for a retirement vehicle. It provides you living benefits. It has extremely flexible premiums. Any growth is locked in. It provides your death benefit. And it gives you the opportunity to take advantage of other investments. So if you were in a life policy that is guaranteed to grow up 4%, then you're going to not borrow against it unless you have an investment opportunity that will gain a lot higher than 4%. If you can borrow from your life insurance policy at 4 or 5% and invest and make higher than that, 6, 7, 8, 10, 12, 15%, depends on what you're investing in, right? But if you have that opportunity, then you want to take it. As that investment pays off, you pay back the loan that you borrowed from your life insurance policy. Now, the great thing about life insurance policy loans is there's no set payback period. If you're borrowing from your life insurance company, they know that they're going to get paid off if you die. If you die, your death benefit will pay your loan. So you're not obligated to repay on a monthly basis in any set, strict format. It's up to you. If you're treating it as a retirement vehicle, you're going to want to make regular payments back on it. If you're in retirement, you may end up just borrowing from the account until you pass away and letting the death benefit pay for it. A lot of people take advantage of it that way. So that's it for life policies. I'm really excited about the opportunity that young folks have utilizing a life insurance policy, helping them accumulate their savings, but have their savings available to them on short notice. One of the other things I forgot to mention was what else this cash value does for you. This cash value, having that available, allows you to utilize higher deductibles in all of your other insurance needs. So if you have auto insurance and you don't have savings, and coming up with $1,000 or $2,000 is a challenge for you, you might go with a $100 deductible. Well, a $100 deductible might cost you an extra $30 a month. A $100 deductible might cost you an extra $30 a month compared to a $1,000 deductible. Stepping up to a $1,000 deductible might save you $360 per year just by raising that deductible. Same thing with your renter's insurance or your homeowner's insurance or your health insurance. Your health insurance, you might have a $2,000 or $3,000 deductible for your health insurance. Well, if you can jump that up to $6,000 or $7,000 for your deductible, you might save a couple $100 a month in insurance costs. So having this cash value available can really save you a lot of money over the course of your lifetime. I've got one other thing to show you, and it has to do with when you're moving out of your house. What are you going to do? Are you going to go rent, or are you going to go buy? What's your financial situation to do that? Do you have a down payment saved up? I want to show you a house hack that works great for young people because you have the ability to move very easily because you're not tied down like somebody like me who's married and has kids. What I want you to do, how you take advantage of this house hack is I want you to find a duplex, a triplex, or a fourplex in the area you want to live. You try and get an FHA loan. That allows you to purchase the place with a 3% down payment. Now, if you get over a fourplex, you're talking commercial properties. But a duplex, a triplex, and a fourplex falls under the same category as a residential home, which is why you can get an FHA loan with a 3% to 5% down payment. Depends on what they're offering at the moment. Sometimes you can get a 0% down payment. What I want you to do is I want you to live in one of the units and then rent out the rest for cash flow. As an example, let's say you got a place for $200,000. You might end up with $300 or $500 extra cash flow throughout the month while your tenants are paying that mortgage for you. Okay? So at the end of 30 years, when you're ready to retire early because you did so well financially, you have what was a $200,000 asset, it's probably now a $400,000 asset, paid off, that if you continue to keep renting it out, once it's paid off, you'll probably have a couple $1,000s a month cash flow, maybe more. Now, with an FHA loan, you're only required to live in it for 12 months. 12 months. What do you do after 12 months? You move out, you rent out the place that you were living in. Now you've got all 4 units, all 3 units, both units. You have all of those rented out, and you do it again. You do another one. So you can do this every year for a couple of years. You get another FHA loan because you're living in it. You can qualify for an FHA loan, and you generate some more cash flow. When you're ready to retire, that cash flow will still be there. The only thing you need to worry about is managing those properties. And you can get people that will manage those properties for you. This is an excellent way to jumpstart your investing and a great way to boost your assets immediately. You increase your cash flow with passive income and you start growing your assets. This is awesome for young folks to do. I hope you will consider taking advantage of this. That's why I'm doing this video. It's my goal to help you take control of your finances. This was a number of ways to do that. We had building up your credit. We had establishing your savings, utilizing life insurance policies, and we have some investment options for our young folks to jumpstart their careers. Thank you for watching. Be sure to hit the like button below and subscribe to our channel for more good info on how to take control of your finances. Check out our Patreon page. We have a community growing there of folks who are interested in helping each other out. And share this with your friends. This is not a zero-sum game. Everybody can and should take advantage of these opportunities to better their financial position in life. That's what I'm here to do. Thank you very much for watching.